So today I wanted to talk about the non-QM space. Non-QM stands for non-qualified mortgage. These are all the loan types and loan products outside of your traditional loans like conventional VA, FHA, and USDA, right? Usually the non-QM space is best for those that are self-employed that don't necessarily have the taxes, W-2s, pay stubs, right? When you're self-employed, lots of times, you'll have income in your bank statement, right? We can actually look at the bank statements for income. So we can do either 12-month bank statement, we can do a 24-month bank statement program. Bank statement loans are very popular in the non-QM space. The way that these are typically approved is there's a few ways that we can look at the income. The easiest way is if you do have a substantial amount of income, what they'll do is they'll basically look at your income and they'll cut it in half. They'll call it a 50% business operating expense ratio. And as long as we have enough income, even with cutting that income in half, it's very, very simple to do these loans. Now, sometimes we need more than 50%. Sometimes we need more than the 50%, basically cutting your income in half. With a CPA letter, okay, so a certified CPA or an enrolled agent, in some cases we can even use a tax preparer, which is great because a lot of people will have a tax preparer but not have an actual CPA. We'll be able to then have them write a letter, after they review your bank statements and after, we give them a little bit of information. They'll basically be able to write a letter that states, no, my client's operating expense ratio is only 30%, is only 20%, is only 10% in some cases. So that will allow the underwriter to give us credit for more income and not just simply slice it in half. So if you have a 30% expense ratio, well, now we're getting 70% of your income through your bank statements instead of only 50%.